Good afternoon, everybody. Fantastic to have you join us for what promises to be a great session as we pick through the challenges and the roller coaster that the US dollar has been on. And for that, I'm very pleased to welcome Arthur Kamp, who is the chief economist of Sanlam Investment Group, as well as the chief investment officer for Sanlam Private Wealth. The format of today's session is going to be that we're going to have the presentation by both Arthur and David, and then we're going to leave about 5 to 10 minutes at the end for questions. So please, if you have any questions, just either raise your hand or you can put them into the the chat screen as well. Otherwise, Arthur, fantastic to have you join us again. Really appreciate your time and look forward to your insight. Just by way of introduction, Arthur is no stranger to those of you who have joined our webinars before. Arthur is the chief economist of the Sanlam Investments Group. As I've said before, Arthur has worked in the investment industry for more than 20 years. He holds an honors in economics cum laude from the University of Stellenbosch and a master's in financial economics degree from the University of London. And then a little bit later, David Lurkey, our chief investment officer, will be on screen as well. And David, too, has a wealth of experience, 18 years experience in investments. He joined Sanlam in 2016. He holds a B Business Science in Finance from the University of Cape Town, postgraduate diploma in accounting, and is a CASA. He's also a CFA charter holder. So more degrees than a thermometer. David, Arthur, wonderful to have you joining us and appreciate and look forward to your insights.
Thank you, Mark. Hello, everyone. So I'm going to share some slides here. I hope everyone is well. So let's get going here. Okay, so hopefully everyone can see that. And the discussion for today is around the dollar. So it's, dollar's been falling. So a lot of that happened the first half of last year, around the time that there was a clear change in direction in US economic policy, or at least an acceleration of what we'd seen under the President Trump's first presidency. But nonetheless, the dollar has been on the back foot generally. So the question is, what has changed? And, why does this even matter? So that's what we're going to try and unpack today. So I'll put my cards up front. Firstly, my basic view, and I've held this view for quite a long while, certainly since as far back as early last year, is that the dollar is, in my opinion, on a long-term structural decline. So to be clear, that doesn't mean it just keeps on falling in a straight line. I think that's important to note. It could have significant periods of strength in between. Remember when the UK pound lost its reserve currency status, it took decades. So this is not a process that happens easily overnight, especially since, first and foremost, the dollar holds one very, very important advantage, and that it's got full convertibility. And it's been the reserve currency for a long period of time. So you don't easily just replace that overnight. So I think that's an important point to make up front. But how did I get to this long-term structural weakness view? Well, firstly, I asked myself, what, in my opinion, would a reserve currency look like? What do I expect from the custodian of a reserve currency? So first of all, I would expect that the central bank of that country is independent. Now, we've had some significant question marks behind that of late about the Fed's independence. We know all about what's been in the news. We know about the nomination of potentially Walsh for chair. We'll unpack that, what that means in a very short while. But I think for now, we can still say that the US Federal Reserve is independent. It's making independent monetary policy decisions. The Financial Open Market Committee is still independent in its decision-making currently. But there has been a question mark. Then I would expect that country to run a very sound fiscal policy. Now, the issue with this is that I have a strong belief, and I think that history shows this up. When you have unsustainable fiscal policy, your inflation risk rises. And of course, you don't want inflation risk rising when you're talking about reserve currency. I would also want that custodian to show an affinity for free trade. Now, we don't need to go into all of that. There's been more than enough written and said and debated around this point, but I think there's a very clear shift away from that principle in the US. I think that's been illustrated. And then sovereignty, respect for the sovereignty of other nations. This is perhaps more difficult to ascertain. But I think the reason I've left this in here, not everyone would agree, but I hopefully it'll become apparent in a minute or two why I did leave that in there. The issue, though, is now I'm talking about structural decline in the dollar, and I've talked about a big decline in the dollar last year mainly. It's been a big move for a currency of its importance. But at the end of the day, it's really only moved back to where I would consider it more or less to be fairly valued. So it was overvalued. So at some point, it was, in my opinion, always going to weaken, and it's gone back to what I would consider fair value. So this is not proof of a structural change, right? So my hypothesis, I can't claim yet that has actually been borne out and is actually correct. So this is another thing to bear in mind as well. But just coming back to the sovereignty issue. So, I've mentioned the factors that I'm watching as to whether this is a currency in long-term structural decline. And I mentioned sovereignty. And I think that's got quite a lot to do with what is happening at the moment, is concern around geopolitics and concern around how that impacts potentially different countries through sanctions, for example, or through, nowadays when you talk about sanctions, you talk about financial sanctions, potential removal from SWIFT, or just generally through geopolitical risk rising, you might find a number of countries preferring to hold less dollars and therefore look around for an alternative. So we've seen emerging markets like China, for example, certainly big buyers of gold, and a number of other emerging market countries doing the same. Middle chart there shows that China's holdings of US treasuries have been declining, so they're less inclined to hold those dollars. And at the same time, not shown on this chart, but the data is available that shows them buying a lot more gold. And that has translated into this point, quite a sharp spike in the gold price. So we're going to get back to this question about these alternative assets, because it's not just gold that you could go to. The other assets, of course, other currencies that you could go to, but gold has been the choice at the moment. And we've seen this complete disconnect between what I call fundamental drivers of gold. When I talk about fundamental drivers, I'm talking about normal macroeconomic drivers, like real interest rates in the US. Higher real interest rates, the opportunity cost of holding gold goes up, and so you would expect the gold price to come down, and vice versa. Inflation expectations, inflation's lifting. There have been inflation concerns. Those expectations, depending on what measure you use in the US, are higher or have been higher. Not so much necessarily all the market measures of expectations, but consumers. When expectations of inflation rise, then also you get a higher gold price. But those factors are not enough to explain what we've seen at the moment. And so this is why I've kept this geopolitical argument there. So where does the gold price go to? I don't know. When you get this kind of disconnect, at some point, potentially people who hold gold say, well, this is a great price, and start selling. We could mean for quite a bit of volatility. We already have. The right-hand chart shows you gold ETFs volatility and how extreme that has been, with a big run-up in price and the very sharp pullback more recently. So it's going to be volatile. And my fallback position on this always is, if I'm holding an asset, individually, people must decide whether they want to hold gold. But of course, the one thing about gold is that it's not earning you income. But just before we get to assessing the other alternatives to the dollar as a reserve asset, again, why would I say that the risk here is that the dollar is fundamentally going to be weaker? And I go back to history. So these arguments about sovereignty and debt levels aside, and debt and potential inflation aside, what else is important here? And if we go back to history, we see that what is important, and here in the mid-1980s is instrumental, is prior to that period, we had quite a sharp run-up in inflation in the US. In the 70s there, you can see the left-hand chart, that big spike in inflation. And then what we had Paul Volcker coming in at the Fed and raising interest rates sharply. Real interest rates went very high, and that's, of course, was to tame inflation. Along with that big jump in real interest rates, we had a big jump, strengthening of the dollar in real trade-weighted terms. And of course, that's what's important for the current account. real trade weighted currency is rising strongly on a sustained basis, you tend to export less, import more, you run this big current account deficit. And of course, the dollar was becoming the world's reserve currency, so it was supplying liquidity to the world and running big current account deficits. Now, we're at a similar level now on the real trade weighted dollar. So for me, this means caution, because the last time around, you can see there in the 80s, suddenly that dollar fell a long way. In real terms. Now, why did it fall a long way? Well, it fell a long way because back then, chart on the right-hand side simply shows the US current account balance. And it indicates that, the current account deficit was quite wide in the 1980s, not as wide as we've had it more recently, but wide enough. And there was at the time an argument and complaint by the US that, the dollar was too strong, that this was that this was disadvantaging the US, that Germany and Japan in particular were running large current account surpluses, and the US didn't like this. And so what we had was a coordinated approach towards weakening the dollar to try and narrow that current account deficit. You can see there that it worked. The coordination between countries like Japan, Germany, and the US resulted in the dollar weakening quite materially. You can see that from the left-hand chart there, just against the Deutschmark, fell from not quite 350, but sort of close enough, to around 150. Sorry, the Deutschmark strengthened from about close to 350 to around 150 against the dollar. So you had a policy in place to weaken the dollar and strengthen the Deutschmark. And at the same time, it wasn't just about these central banks buying and selling dollars to get the desired outcome. It was about coordination of policy approaches. So Germany and Japan were going to run stimulatory aggregate demand policies, and the US was going to, very importantly, and this is something we have to bear in mind, because I'm going to talk about this in a very short while again, is that it agreed to narrow its budget deficit, because that had a large budget deficit at the time. The Graham-Rudman-Hollings Act came in to narrow that deficit, and that deficit had been reflected in the current account deficit. So narrowing that would narrow the current account balance. So a combination of all these factors, weakening dollar, strengthening yen, strengthening Deutschmark, and these aggregate demand policies and fiscal policy came together, and we had that current account narrowing. And this is the problem for the Trump administration at the moment. They make no bones about it. They don't like this large current account deficit. The flip side of this current account deficit is large capital inflows, of course, into the US. As it's in its function as reserve currency of the world. So, that does create something of a dilemma. So against this background, I think that, either by design of policy or because of the factors that I've mentioned, I think that this dollar is in a longer term structural decline. Now, there are various outcomes that are possible here. I think the way that it's panning out at the moment, if you simply look at current developments, is that we seem to have, searching around for additional assets other than the dollar, but not necessarily large-scale selling of the dollar itself. So in other words, over time, you could starting to see diversification into other assets, and that would hopefully translate into something more of a smoother transition, as opposed to something that's more violent or very, very disruptive. The problem at the moment, of course, is that the alternatives, there aren't ready-made alternatives. So in Europe, Euro, we need a singular capital market. We don't have that. China, we need greater convertibility of the currency. We don't have enough of that yet. Capital controls, etc. And then you can talk about the Swiss franc. The Swiss don't want to run the large budget debt levels required, the government debt levels required to be the reserve currency of the world. So they're reticent to take on that role. And you can talk about other assets. Some people talk maybe about crypto. In my opinion, that's not an alternative to consider. So we've ended up with gold for now. But I think over time we will look for alternatives, and those will emerge. Of course, other things can happen. You could have something where, because of this current account deficit, the US doesn't like it. If the president does get his way and start narrowing the current account deficit, that would go along with a weaker dollar, but then potentially also other policies. You try and discourage capital inflows into the US, maybe some sort of tax on inflows or whatever it might be, something along the lines of a Plaza Accord. Now, when I say that results potentially in financial dysfunction, it doesn't mean everything falls apart. It just means that things are impaired. Allocation of capital isn't what you would like. As soon as you introduce capital controls, you impair the allocation of capital, as opposed to all fall apart. Of course, the all fall apart scenario that one could envisage, but I do think that is, my opinion, this is a low probability, is you sort of weaponize the dollar. So in other words, that the dollar at the end of the day is the world's reserve currency, and it needs to supply liquidity to the world. And in doing it, from time to time, if it wanted to, say now for example, you had another something similar to the global financial crisis, and you withhold dollar swap lines from the rest of the world, that sort of thing, then you start getting chaos, right? I think that's a low probability. Of these, I think that on margin, structurally weak, looking for alternatives. For now, it's gold. Probably, in my opinion, won't always stay gold. Start finding other assets to diversify into. So hopefully it's not something chaotic or anything like that. But there we go. So that's my opinion. So what does that mean? That means that the Fed is still important to us. End of the day, the US Federal Reserve is the world's reserve currency central bank, and it's going to stay relevant. Now, that means we need to watch a lot of indicators. One of them we like to watch, we watched recently, for example, is the real risk premium in the US, which did jump quite significantly when in fact, before we had President Trump's second term. Part of that may be concerns around debt levels in the US, real risk premium rising, but that's now settled back down again. So that is encouraging. At the same time, it's now time to just discuss, the Fed. What is the Fed going to do this year? So the general expectation is the Fed's going to cut a couple of more times. I think we need to think about that. It's not a guarantee. And the reason it's not a guarantee, what is the left-hand chart showing me? The left-hand chart is showing me the US neutral rate. So that's the neutral rate as assessed by the US Federal Reserve. And it thinks that the neutral rate for the economy over time. Now, the problem with the neutral rate is academically determined. It's not something you directly observe like in a market price. But I think it's probably around 1%. So the Federal Open Market Committee uses about 1% real at the moment. So if you've got a long-term inflation target of 2, and you believe inflation will be 2, you expect that, then 2 plus 1 is 3. And so your nominal neutral rate is 3. At the moment, you're 3.5 to 3.75. So you're not very far above that neutral. And you do, in my opinion, have some inflation uncertainty. Yes, the latest prints were quite low. Not low, let's put it this way, benign relative to perhaps expectations. We didn't have October measured. We didn't have November measured. December wasn't exactly a particularly strong number. But I do think that you've got to be wary. The core PCE deflator that the Fed tracks is very close to 3%. So that's a long way from its 2% target. Disinflation last year in the US was helped by rent price inflation coming down. And I do think that there is still significant feed through potentially from these tariffs. We're never going to, in my opinion, hit overnight and be done one and done. I think that they could still feed through this year. So there's, to my mind, still uncertainty. And if the economy holds up okay this year, we get back to this point. If the economy holds up okay, then focus could shift back towards inflation. And if the Fed shifts its attention back far more sharply to inflation rather than the poor wage data that we've seen, maybe you don't get as many rate cuts. So you get some volatility. But nonetheless, we were already getting towards the end of the rate cutting cycle. I think that was already reasonably clear, in my view. Said I'd get back to nominee Walsh now, or nominated Walsh as Fed chair. We don't know, essentially, before a chair gets in the direction that he's necessarily going to take. We've got a fair idea, but we would be watching for certain things. He seems to be quite in favor of the argument that AI can keep inflation low and help you grow the economy faster. But it's not obvious, though, at the same time that he is naturally tolerant of inflation. So although you might point to previous statements about cutting rates and so on, I don't think we should read too much into that. And it's the entire FOMC committee that must make these decisions anyway. More interesting, in my view, or equally interesting, should I put it that way, is that he has had a view in the past about the Fed's balance sheet being too large and that it needs to shrink. Now, the Fed's balance sheet has been running off mainly by just not reinvesting the principal. And it's slowed down that process quite significantly. So the Fed's balance sheet is still large relative to the size of GDP. And the reason why this is important is because his argument is that, you know, a lot of this, bottom line is you don't want to be running big budget deficits in the US. He doesn't like that, high debt levels. And of course, the Fed's balance sheet, they hold a lot of US treasuries. So he doesn't like that from previous communication. Of course, again, you know, this could change. People can change their opinions. But I have sympathy for that view if he still holds it. And the reason I have sympathy for that view is that historically, large budget deficits, the middle chart there shows you cumulative federal budget deficit, how that accelerated during the pandemic when you were writing checks and sending it to people, and how the money supply accelerated at the same time. And we saw the result in inflation. Money supply subsequently slowed down very sharply. Along with that, we had disinflation as well. But this cumulative budget deficit has continued to climb strongly. And over time, I still have a concern that high debt levels and unsustainable fiscal positions, the US should have been running a much more counter-cyclical fiscal policy than it has. It's been growing well for an economy of its size. And, you know, to be running federal budget deficits of around 6% of GDP and still expected to remain more or less at that level is just too big a deficit. So I have sympathy for that view. Why it's important and something that we should continue to track is if the Fed, again, it's the entire Federal Open Market Committee that votes. It's not just as simple as someone coming in and changing the way that they look at the world. But watching the Fed's balance sheet will be important because shrinking the Fed's balance sheet very often coincides with less liquidity available in emerging markets. The moment VIX is low, risk appetite is good, liquidity is plentiful. But if you started to see a Fed starting to shrink its balance sheet quite significantly or aggressively, then that could change pictures. A picture again creates some volatility. So these are all the things that we monitor. So to get towards the end, I did indicate that the Fed might shift focus back to inflation if growth held up reasonably okay. And I must say, growth has not slowed through last year as I thought that it. And when you go look at it, I'd have before indicated that one of the key reasons for that is a very high level of profits to GDP and also wealth effects in the US. The stock market being very buoyant, and when you feel wealthy, you don't save and you consume more, and the savings ratio and the rate compared to history in the US amongst consumers is very low. So that's been holding up growth. But for me, the thing that stood out, and the economy actually would have slowed significantly more had it not been for spending on software and similar information processing equipment, IPE. So we can see from the left-hand chart here how investment in information processing equipment has continued to rise very sharply. It's just a straightforward index. And private investment, excluding that, is actually sort of flattened off. Right-hand chart shows the direct investment into GDP as a contribution to GDP. And it's just the direct effect, not the indirect effects. And you can see there the big difference that it's made last year. So this growth is pretty narrowly based. Interesting, I see reported that these top tech companies looking for $660 billion of investment in AI this year. Last year, I think the number was just between 400 and 420, somewhere around there, $1 billion. So this is an additional over and above another 0.7% of GDP. That weighs on the current account as well, which we've discussed. So growth could be pretty narrow, and a lot depends on whether they, on this, number one, funding it, but number two, the returns that you're going to get from it. But David can speak a lot more eloquently to that than I can. The point I would like to make to finish off is that, in this pursuit of a smaller current account deficit, President Trump doesn't want to run a large current account deficit. He's using tariffs not just to do that, he's using tariffs for all sorts of other things as well, we know. But the idea behind higher tariffs would be to obviously narrow the trade imbalance goods and more in the favor of the US. So let's think about what does that imply. What that implies is that to shrink the current account deficit, and this is a fact, as percentage of GDP, you have to either save more, or you have to, if you save more, you're consuming less, or you need to invest less. So you either save more and invest less. That's the only way to shrink the current account deficit. if the US government is going to continue running a large fiscal deficit, federal deficit still expected to be around close to 6% of GDP this year, then the adjustment's not going to come from the US government. If foreign players like China are buying less US treasuries and supplying less capital in the US, that means that this adjustment falls on the shoulders of the private sector in the US. And if, and it doesn't seem, as I say, these big tech companies, doesn't seem like they've been investing less. They seem to want to be investing more. So somewhere along the line in the private sector, it takes a hit. And against the background of quite an expensive equity market, in my opinion, that could be quite a disruptive type of event. So these are all things that we look at. There's nothing new here. We're used to volatility in the global environment. We've seen it before. We obviously keep on tracking all of these factors. But the bottom line of what I'm trying to say is long-term structural decline in the dollar doesn't mean it falls there in a straight line. The choice and the pursuit of an alternative is going to be very interesting to watch as to what that ends up being. But what we have seen over the past year, I've just used South Africa as an example here, is that this weakness in the dollar is combined with the Fed rate cuts that we've had and the liquidity injection or the improvement in global financial conditions that's implied, has been pretty good for emerging markets. We know that. The rand has come back quite materially, and many currencies on our continent behaved very well last year, considering the geopolitical and geoeconomic backdrop. Spreads came down, obviously not everywhere. A couple of countries still have fiscal issues, but in many where you have fiscal consolidation and this favorable backdrop, you've seen a very, very favorable year for currencies and interest rates. Yeah, things don't always go in a straight line. Maybe things get a little bit more volatile. We'll have to wait and see. But these are the factors that we suggest you track against that backdrop. And then I'll leave it up to David I'll hand back to Mark to hand over to David.
Thanks, Arthur. Very interesting. Just for those on call that missed the start, we will have an opportunity for you to ask questions. Otherwise, you can post in the chat. So, David, Arthur's a snapshot of Arthur's message is long-term structural decline in the US dollar, although it doesn't fall in a straight line. As money managers, does this have any effect on how we approach managing our clients' money at all?
Thank you, Mark. It certainly does. Our job is to manage our clients' money in such a way that it can grow nicely in real terms over time. And so if you have a look at how our portfolios for our clients are currently positioned, I think the first thing is that on a net overall basis, we are a little bit underweight US assets and a little bit overweight emerging market assets. We also make sure that in a world, as Arthur describes, where there's lots of uncertainty, and particularly around timing of certain things, we make sure that we have proper diversification across both geographies and by sectors within the equity component. Typically, there are always risks around emerging markets, but typically emerging markets like a weaker dollar. That's generally good for emerging markets, and that's part of why we have some emerging market exposure in our global portfolios. If I then just pick up on, I think, quite an important point. As Arthur said, it's not linear. So understand that while over a 20-year time horizon, we would expect the dollar to broadly weaken, it doesn't happen perfectly smoothly. And don't forget, the US tech sector is probably still the most dynamic part of the global economy. And a lot of those businesses, most of those proper big tech businesses, aren't just US businesses, they're global businesses. So with that, don't abandon all US assets, definitely not. They've still got fantastic businesses in the States, but make sure that you have proper diversification within a portfolio. And then also remember that, an additional argument around the future of the dollar is, of course, that the alternatives being Europe, China, Japan, they all have real demographic problems. By contrast, The US still has a growing population. It doesn't have kind of demographic problems that certainly Europe, China, and Japan have. So that also helps the general dynamism of that US economy. And then I think just we always have to understand when putting a portfolio together that we can have a pretty good idea of what happens over 5 or 10 years. We have very little idea of what's going to happen over 1 month or 3 months. And we must therefore always be careful not to have knee-jerk reactions. We're looking to invest our clients' money over an extended period of time. And therefore, we've got to build portfolios accordingly that are actually quite robust to all the different things that will be thrown at us. We showed it last year. April time, the markets fell quite substantially. Our clients' portfolios fell far less than that. And then we took advantage of that panic to then deploy assets deploy money into attractively priced assets. So we must always have portfolios that are robust so that they can handle these various shocks that will appear. And don't throw the US out completely, even though we do expect that US dollar to deteriorate over a decade.
Thanks. That was, of course, David, Chief Investment Officer of Sanlam Private Wealth. Thanks, David. David, our attendees, and I'm told by our technical guys in the background that we've got attendees from all over Africa as well as our Indian team. So welcome to our Indian team as well and our colleagues and clients there. There's a couple of questions. Ravi Ram from India, I believe that you had a question. You can go ahead. You can either post it or you can unmute yourself and ask the question online if that's easier for you. While Ravi Ram unmutes himself, let's go to Warren from Mauritius with a question. Warren.
Yes, hello everyone. So my question is to Arthur, actually, please. So I was wondering, could the recent weakness in the US dollar be potentially beneficial for the US economy, trade competitiveness, and external demand? Thank you.
Arthur, did you get that question?
Hi, Warren. Yeah, I heard the question. So on margin, everything else equal, the answer is yes. So, we saw that in the 1980s. So when the dollar fell a long way in real terms. So the important if here is that you keep inflation under control, right? So if your currency falls a long way and your inflation is sky high, you erode the price competitiveness. But if you manage to keep inflation relatively low, and at the same time you weaken your currency strongly and the currency falls a long way in real terms, then all else equal, that does lead to an improvement in your current account balance. And that's why I say, if you're going to narrow the current account deficit in the US, it's going to be accompanied by a weak dollar. It gets a bit more complicated, I guess, than that, because now it's, the US has been running its economy. It's got a rising unemployment rate, but it's still a relatively low level of unemployment. We don't really know where that long-term equilibrium unemployment rate is, the NAIRU of that economy. But so if you're going to stimulate this economy, you have to then divert resources from where it is into exports. And so it's not altogether clear that is an easy thing to do. But you're right. If the dollar falls a long way, it improves the trade balance. It makes the country more price competitive. It's not the only thing that determines overall competitiveness, but it's one of the important implications of it. The question is, how fast do you want that adjustment to happen? And the other question is, what is the flip side of that adjustment? The flip side of that adjustment in the current account, the way I look at it is there are three major players in any economy. One is government, the other one is the foreign investor, and the third one is domestic private sector, including households. There's no economic theory that I know of that says who must lend money to whom, who must borrow from whom, but I do know the whole system must add up to naught. So, if the current account deficit is narrowing sharply, it means the flip side of that, less capital inflows. So there will be less capital inflows from abroad. That leaves the adjustment up to the other two players. And if the government doesn't want to do the adjustment, then the adjustment is going to fall on the private sector to do that. And that's the other thing we need to bear in mind, is that a falling currency makes imports more expensive, makes exports cheaper, and that fall in imports is a reflection then of an adjustment to lower consumption and investment. So that's the point I'd like to make, is that one thing leads to an improvement in something, but there's something else happening elsewhere in the economy as well.
Thanks, Arthur. Thanks, Warren, for the question. There's quite a few questions coming through. We're not going to be able to get to all of them, but we're going to try and get to as many as we can. David, there's one for you from Nelco Mose in Kenya. There has been a sell-off in software stocks that has wiped billions from markets. Do you see this extending for longer? Do you see this as an opportunity to buy the dip, or do you see AI replacing software companies?
Yeah, I mean, it's a fascinating question. The short answer is I think it's more of a buy the dip thought process than AI wiping software companies out. But a lovely quote from Jensen Huang last week, Wednesday. Jensen Huang, for those on the call who don't know, is the CEO of NVIDIA. So he's a very important man in the world nowadays. And specifically the quote is this. He says, "There's this notion that the tool in the software industry is in decline and will be replaced by AI. It is the most illogical thing in the world, and time will prove itself. If you were a human or a robot, artificial general robotics, would you use tools or reinvent tools? The answer, obviously, is to use tools. That's why the latest breakthroughs in AI are about tool use, because tools are designed to be explicit." Anyway, quite a long quote there from Jensen Huang, but this answer is that I think the market's getting a little bit too concerned about software companies and the kind of moats that they have and the longevity of their business models. AI definitely poses some threats. You don't have markets move this far for nothing. But I think the net best guess is to buy the dip, but always for our clients all around the world, we say, don't be too much of a cowboy. Buy the dip, take the opportunities, always make sure your portfolio is robust to a variety of potential outcomes and that it can handle a little bit of volatility in any given stock because all the pieces in the portfolio fit together appropriately in such a way that the portfolio itself gives the right outcome in the end.
Thanks, David. Apologies again to our attendees. We're not going to get to all the questions, but we'll try our best. Alan Hodgkinson, you had your hand up. I wonder if you can ask your question. I see it's not typed, but if you can just unmute yourself and ask the question. It seems we've lost Alan. Oh, there you go. No, not. All right, then I'm going to read another one. Arthur, this one looks like it's for you. Do you think de-dollarization with countries reducing their reserves in dollars is around the corner? And how is it going to impact asset class like metals in long term? Arthur, I'm going to leave that one with you, and you can bring David in on the second part, I guess.
Yes, I think we've already seen over what's happening is that it's diversification into other currencies. So the dollar is still the dominant currency held amongst reserves. It has been declining gradually as a share of total reserves, and we've seen diversification into other assets. So it's as central banks acquire new assets that they diversify into other currencies, but it's not as if there's a wholesale selling of the dollar at this point. So I think that process continues. So from one perspective, I guess a lower dollar, commodities are priced in dollars. So if the dollar falls, commodity price goes up. But I'll leave it up to David to talk about commodities. But the way that we do view it is we think that there's a structural support for commodities And unfortunately, it's because of the military buildup that we're seeing globally. That's metals and minerals intensive. And also to some extent, the shift towards, or the attempted shift towards a net zero carbon future is also metals and minerals demanding. So we think that there's a good long-term commodity story there. But I'll leave it at that and for David to comment.
Yeah, maybe if I just add one or two extra things there, is that typically weaker dollar does correlate with stronger commodity prices in dollars, because the price would then stay the same in yen or euros or rupees. So that's the one side of it. Also, when there is this concern around the world about stability, then typically people want to hold a little bit more hard assets, which can be useful more for precious metals type of commodities. And then maybe just an extra thing to add to what Arthur said is, with the rise of AI, that is also quite materials intensive for certain of the commodities, particularly copper. So I mean that is a mineral that we think has quite a good price future ahead of it. I think a lot's being baked in already, but the world should be in copper deficit for a while. That should support prices of copper, and we quite like the copper mining companies. And yeah, I think let me leave it there, Mark.
I'm going to take the last question because we've got a minute to go that we allocate. Thank you for your patience and everyone staying online. Fascinating subject. This is an interesting one, Arthur. I think this is going to fall into your camp, and it's again from our Indian colleagues. Vinod has asked, in India, dollar appreciates by around 5% per year. I'm assuming that's against the Indian rupee. Will that get arrested from this year onwards? That's the question, Arthur. Do you have a view on Indian rupee versus USD?
I don't have a view on timing, but I do have a view that the Indian rupee is undervalued relative to dollar. So, but unfortunately, timing in currency markets is just, I've tried that in the past and not with good results. But I would say, in my opinion, it's undervalued. The Indian rupee is undervalued relative to dollar.
David, you're smiling, Riley. Anything you want to add to that or nothing?
Yeah, just, as Arthur says, short-term figuring of currency markets is exceptionally difficult. But what I would say to Vinod is, historically, there was a relatively wide inflation differential between India and the States. That's driven that roughly 5% depreciation of the rupee versus the dollar each year. Going forward, you might say that instead of on average over the next 10 years, like the last 10 being maybe 5%, over the next 10, it would maybe only be 2% that depreciation versus the dollar. And in sort of short to medium term, kind of 1 to 3 year view, I think there is probably some scope for that to essentially be arrested for the next few years. But as Arthur says, predicting currency is a very difficult game, and one shouldn't rely on it too much.
Arthur and David, I'm going to call time there on our session today. We obviously will have other sessions during the year, but it's been an absolute pleasure having you illuminate some of this topic for us. Really appreciate your time. Thank you to everyone for dialing in. Apologies to those whose questions we didn't get to. I've been receiving WhatsApps as well. Please email me and we'll flick them on to either David or Arthur to answer. But otherwise, thank you very much for attending. The recording of this session will be sent to you if you do want to view it again. But otherwise, thank you for joining us, and it's been my pleasure to host you. Thank you.